Welcome to Alligator Bay Crypto Club. Today we are not chasing a candlestick or guessing the next 100 times token. We are watching a financial infrastructure migration that has already reached production. 15 years ago, crypto promised to replace banks, brokers, and Wall Street. Now the plot has turned. Crypto companies are helping Wall Street build faster roads, settlement rails, and collateral systems, then charging for the technology. The Depository Trust and Clearing Corporation says its subsidiaries processed securities transactions worth about $4.7 quadrillion in 2025. On July 15, DTCC converted securities in custody into tokens and used them in real production transactions covering collateral pledges, securities lending, treasury and repo delivery versus payment, stock settlement, and clearing margin movement. More than 30 traditional finance and digital asset firms participated. The formal service is planned for October 2026.
Let me begin with a thorn. Young revolutionaries imagine that change only counts when the old palace burns. The I Ching says exhaustion produces change, and change opens a path. Buddhism says nothing exists without conditions. Blockchain began with rebellion as its cause, efficiency as its opportunity, and Wall Street as the place where the result appeared. The crypto demon now wears a tailored suit and carries a thermos of goji berries. Is that good fortune, or the sorrow of growing up? Rebellion that survives only as a pose becomes merchandise. An ideal that enters institutions, lowers costs, and changes how capital moves may not have surrendered. It may have found a quieter victory.
Why would financial giants adopt technology they once rejected? The first answer is not faith. It is cost. A stock purchase on the New York Stock Exchange still takes a full business day for final legal settlement. The system descends from the era of paper certificates. Trading became electronic, but money and asset delivery still depend on business hours, batch processing, time zones, and weekends. Cross-border banks pre-fund accounts in different countries and currencies so payments can clear. Securities traders lock up margin while settlement is pending. Clearing systems may pause on Friday evening, but market risk does not. Everyone pays an invisible waiting tax. Trapped capital, idle collateral, and lost opportunity. Global corporate cross-border payments total tens of trillions of dollars each year. Even a small reduction in friction can create enormous economic value. The old machine is not slow because nobody noticed. It is slow because every participant learned to live around its delays.
The most expensive object in finance is often not a fee. It is waiting. Heraclitus said everything flows. Daoism watches the river move without asking permission from office hours. Yet old finance orders money to sleep on weekends, as if time obeyed a bank's door lock. Force capital to remain still and you create trapped liquidity, larger margin demands, and higher costs. Those causes return as consequences. Mysticism is not blaming every price move on Mercury retrograde. It is respecting timing, position, and relationship. A dollar available today does not share the destiny of one available tomorrow. What people call luck is often capital moving one step earlier. Any system advertising 24/7 finance while its collateral takes weekends off is practicing immortality in public and punching a time clock in private.
In May 2024, the United States shortened equity settlement from T+2 to T+1. Compressing the cycle by a single day reduced the margin deposited by clearing participants from roughly $12.8 billion to $9.8 billion, a decline of about $3 billion, or nearly 23%. That was not a cosmetic improvement. It released real capital. Tokenized securities extend the same logic. Stablecoins can move in seconds, all year. Tokenized shares, treasuries, and fund interests can transfer ownership and become collateral almost immediately. A security that settles tomorrow cannot finance a position today. If settlement finishes in minutes, that same asset can be pledged, lent, or used to meet margin. DTCC's production work covered equities, U.S. treasuries, exchange-traded funds, repos, and securities lending. Participants included BlackRock, Goldman Sachs, Morgan, Vanguard, the New York Stock Exchange, NASDAQ, CME, Chainlink, Circle, Fireblocks, BitGo, and Digital Asset, the company building the Canton network. This migration is not limited to securities. On July 9, SWIFT said its blockchain ledger was ready for initial use. 17 banks across 6 continents will test tokenized deposits, including Citi, HSBC, UBS, Standard Chartered, and MUFG. The system allows bank-issued deposits to move at night and on weekends while keeping familiar compliance, credit, and risk controls. A tokenized deposit is not an anonymous meme coin. It remains bank money. It borrows the round-the-clock mobility of stablecoins without asking institutions to abandon their regulatory perimeter. On July 16, Visa also introduced a stablecoin platform for banks, fintech companies, and payment providers. It offers minting, custody, redemption, wallets, and treasury management interfaces. Private keys, public chains, and gas fees disappear into the backend while customers see a familiar financial product. Blockchain is beginning to resemble Internet Protocol. Most people do not understand the plumbing, but they rely on it every day. The revolution becomes strongest precisely when the user no longer needs to pronounce its name.
Here we must remain difficult. Entering a large institution does not grant technology a moral victory. Efficiency can distribute opportunity, but it can also concentrate power. In Buddhist thought, reincarnation is unresolved desire changing costumes. Yesterday, promoters sold empty tokens in the name of decentralization. Tomorrow, they may package old risks under the respectable name of tokenization. If custody, upgrades, redemption, and information remain controlled by a few institutions, the chain may be fast while the system stays opaque. Still, imperfection does not make progress false. Confucian statecraft and Western pragmatism ask ideas to face measurable results. If tokenization reduces idle margin, keeps cross-border money available on weekends, and lets treasuries earn while serving as collateral, those gains are real. The danger is not technology wearing a suit, it is discovering the same hidden ledger inside.
The business model of crypto is changing. Chainlink provides data and interoperability across networks. Digital assets Canton network supports regulated asset movement. Fireblocks and BitGo offer institutional custody and wallet infrastructure. Circle, Ondo, and Securitize provide stablecoins, issuance systems, and asset management rails. These companies once tried to build a parallel financial world. Now they sell the technology accumulated in that experiment to traditional institutions. On July 16, Ondo Finance announced a partnership with Japan's SBI Group to advance tokenized Japanese equities and explore settlement with yen stablecoins. Securitize supports the issuance of BlackRock's tokenized treasury fund, BUIDL. Morgan's Connexy's platform has processed trillions of dollars in on-chain transfers. The new profit logic is clear. Stop rebuilding the same consumer exchange and sell custody, compliance, issuance, interoperability, clearing, and collateral management. It sounds less heroic than revolution. It also looks more like durable cash flow. Infrastructure rarely wins applause, but it sends invoices for decades. In 1956, Malcolm McLean popularized the standardized shipping container. Loading costs fell from about $5.86 per ton to roughly 16 cents. Global trade was reorganized, but shipping companies did not capture every benefit. The container became a common standard. The greatest advantages went to businesses that rebuilt supply chains around cheaper logistics. Financial tokenization may follow the same path. Once blockchains and token formats become standardized, simply selling block space may not earn the highest returns. Value may flow to DTCC, SWIFT, and Visa because they control customers, licenses, and distribution. It may flow to technology providers that solve custody, compliance, interoperability, and collateral efficiency. The largest opportunity may belong to companies that redesign treasury operations around continuous settlement, keeping collateral productive, shortening the sleep of idle cash, and allowing the same asset to create more utility without leaving a controlled risk boundary.
Now we can answer the opening question. When the crypto demon puts on a suit, is that good fortune or the sorrow of adulthood? It is both. The good fortune is that the technology did not die inside adolescent slogans. Some ideals became faster settlement, more efficient collateral, and money that can move on Sunday. The sorrow is that every ideal entering reality meets regulation, interests, compromise, and a fee schedule. The Dao De Jing says reversal is the movement of the way. The technology most hostile to Wall Street now enters Wall Street. The industry obsessed with removing trust now upgrades the oldest trust institutions. That is not simple betrayal. It is cause and consequence completing a circuit. Technology planted efficiency. Institutions supplied scale. The result belongs neither entirely to crypto purists nor to old finance. So do not ask only which chain will rise. Institutional adoption is not a lottery ticket. Real luck depends on whose balance sheet receives the value. Real causality depends on who lowers costs, carries risk, and controls redemption. Wearing a suit is not shameful. The shame is drinking goji tea, praising revolution, and merely renaming old fees on chain. Ghini's verdict. Crypto did not conquer Wall Street, and Wall Street did not tame crypto. They met at a crossroads and exchanged tools. Luck rarely falls from the sky. It arrives disguised as the first technology service invoice after 10 years of boring construction. See the trend and the price. Respect luck, but respect causality more.